Emily. Ahead of time, we've collected some questions that have been frequently asked to our firm, and we're going to use those questions to get started. Again, just to reiterate what Emily mentioned, use the chat feature to submit other questions, and we'll take moments for those that are joining on this webinar that are calling in. We'll prompt you periodically so then you can participate as well. The first question I have received frequently, I'm going to direct to you, Bill. It's about the market responsiveness and how it feels a little bit like an overreaction. Stock buys and sells are rather erratic, plus or minus 5% on a daily basis. How do you think? How as an investor, this is concerning. It's really hard to make decisions. What are your insights as to why the market is acting so erratically?
Well, I think the initial sell-off really was it turned into a market panic. Just about every class of assets was sold back in March, from stocks to gold to treasuries, indiscriminate selling. And then almost as quickly, we had a extremely strong rebound based on the outlook for the infection rate beginning to moderate. And I think where we stand right now, my sense, and we talk about this a lot in our investment meetings, I think where the market is now with this strong rebound is that it's priced in the likelihood that the virus itself, the infection rate is moderating, and we've likely hit the peak, and we're probably starting down the other side of the curve. But what I don't think it's priced in are the economic ramifications, which look like they're going to be pretty severe. And we're only beginning to get some data points now. Obviously, I'm sure everyone's seen the unemployment numbers. We're starting to get some first quarter earnings reports from public companies. Virtually all of the companies have withdrawn guidance for the second quarter and for the full year because of the uncertainty. The longer this, the lockdowns go on and the social distancing goes on, the more difficult it's going to be, especially for small businesses, to keep their heads above water. The government programs that are, that have and just recently been approved, like the Payroll Protection Plan, has had some well-publicized glitches with large companies that don't really need it, getting a lot of that money and thereby effectively preventing smaller businesses who it's supposed to go to from getting it. So that's got to be worked out. But I think the market right now, from my perspective, looks like it's a little overpriced, and it's not really pricing in. Maybe it doesn't know how to price in the economic ramifications, because we really don't know how this is going to play out. This whole situation is completely unprecedented. So we're not sure how it's going to work out, but right now it looks pretty severe.
Can you add to that, Jason? I know an area of interest for you is understanding consumer behavior and how our emotions can affect pricing, and we're seeing a lot of that as well. Bill outlined some economic factors. Can you expand on some of our behavioral factors that are affecting some of the pricing?
Sure. What we're seeing a lot right now, in some ways, in terms of investor decision making, is a little bit of following the herd, if you will, and that has impacted both the market as well as the grocery stores. I mean, we're seeing that with empty shelves and so on. I think Bill would agree the market doesn't like uncertainty, which is what we saw very early on. And not just the market, but all of us in general. We tend to be risk averse, so we will take actions that will avoid risk, and we will tend to follow the group in a lot of ways. So in agreeing a lot with what Bill says, what we need to be very, very careful of is looking at what the market is doing, and in a recovery, or maybe a short-lived recovery that we've seen over the last couple of weeks, assuming that that this is all over and now it's time to get in, and feeling like we're going to miss out on something, and remain very vigilant about reviewing our portfolios and risk allocation. There's more to come here. The first quarter is results that are half-baked, essentially, with partly a good start to the year, and then a terrible back half to the second quarter. Best case scenario might be that the second quarter starts off pretty poorly and recovers because economies start to open. That's probably not likely the case. That would be the best case scenario. We need to be very disciplined in our approach and step away from the emotion, and that's what tends to happen for all of us, is allowing our emotions to kind of take over, and again, following that herd mentality. Really stepping back and making sure we're making decisions that are the best decisions for us. So.
Let me ask you, Bill, off of, we mentioned Q1 financials, those are just being released as we speak. I know about 20% of S&P 500 companies have released their Q1 financials. Have, outside of what we've commonly heard with energy, are there any other trouble sectors that you've noticed, Bill, that may be being impacted that's not being talked about?
I don't know if there are any that haven't been talked about. Pretty much every sector has been negatively impacted. The notable exceptions being companies like Amazon and Walmart that sell consumer staples, grocery stores, any type of company that benefits from the stay-at-home or the work-from-home trends, such as the venue that we're using to conduct this webinar, for example. Companies like Zoom. But other than that, I mean, just about every company in every sector that I've looked at has had some kind of negative impact in one way or another. I think some will perhaps rebound earlier than others, but that remains to be seen. Again, I think a lot of it depends on how long the stay in place or shelter in place mandates continue. We've got a couple of states that are now tentatively opening things up. Hopefully that will work out and won't lead to a second wave of infections. I think if we saw that would certainly have a big negative impact on investor psychology, and I think that the market would obviously be at risk there.
Yeah. Emily, can you ask the question? We've been getting a number of bond-related questions. Did you want to ask the next one?
Sure. It looks like the question was, will my bonds default? And then, William, are the oil prices related to that? The next part.
No, that's a separate one. I'm sorry.
That's okay. Okay, so just will my bonds default?
Yep.
Well, why don't I start on that one? Bonds are really, really a different animal here from the stock market. Everyone probably has a solid handle on how equity markets work in general for the common investor, which is, your goal is to buy low, sell high. We're not always perfect at that, but that's the intent, and you're buying shares of stock. Bonds, you are becoming a creditor to a company. And so to answer that question, you just like we would walk into the bank and ask, for a mortgage or something like that, the bank would check our credit worthiness. And so to answer the question of will my bonds default, you have to look at the credit worthiness of the companies you may own bonds in. Now, most of us individual investors hold bonds in mutual funds or exchange traded funds. Those are pretty hard to sort out. I mean, there are some things that you can do right now to make sure that the bond part of the portfolio is serving its purpose, which should be safety, security, principal protection at this point. If you are an individual bond investor, credit ratings from S&P and Moody's, these are published and so on. So, to take a look at your bond portfolio on an individual basis, that's good exercise to do. When you're investing in funds, the best thing you can do there is look at some of the broad dynamics of the fund. What's the term? What's the duration? Is this an intermediate term bond fund? Is it a short-term bond fund or a long-term bond fund? Some bond funds really do focus on higher risk or international bonds and so on. So, to understand if your bonds are at risk of defaulting, understanding those things, we would typically probably recommend for the most part right now that people stay on the shorter term end of the curve for bonds if you're looking for that investment to be safe and secure, provide that principal protection. Look, interest rates are basically zero or near zero at this point. There's not a lot of income to get off of these. This should be safe and secure part of your portfolio if you're looking at this. If you're a higher risk investor, certainly there are opportunities in what we would call higher risk bonds or junk bonds or lower rated bonds and so on. The bond market in general, though, kind of as we're stepping away from our individual portfolios for a moment, and if you were really to dig in and look at everything that the federal government and the Federal Reserve is doing to keep liquidity in that market and keep those defaults or the default risk low, I would say that the federal government and the Federal Reserve are doing just about everything they can, and they have to. I mean, in a situation like this, they have to be the ones coming in and propping that up. So there is some confidence, if you will, given that we're going to have that support, from those entities. So.
Yep, no, that makes sense, Jason. You mentioned about portfolio management. There are some concerns. Back in 2001, 2002, employer contributions decreased in correlation with the tech bubble. So this next question, I think, is in reference to that event. Do you anticipate cuts being made by employer contributions during this health crisis? If that does happen, what are some maneuvers the employee can make on their own to make sure that they're not shortcutting their retirement goals?
Well, and even beyond that, Will, if we step back and look at everything that the employer contributes to an employee, right? So you start with just the day-to-day salary that they're making. It could be contributions towards a health plan that they're splitting the premiums with or other types of insurances. And then I think what you're referring to as well is these matching contributions potentially in a retirement plan that the employer has established for their staff. What I'm hearing is that a lot of employers are trying to be very focused and be employee friendly for now, right? Keep them employed, keep the insurance program going, and that's what we're seeing a lot out of these programs of the federal government. The stimulus packages that are going through the SBA is trying to help employers prop that up, right? Keep people on the payroll, keep the health insurance rolling, things like that. So there are contributions there. I am also hearing, yes, that employers are considering cuts in those matching programs for retirement plans, 401ks, et cetera, that they've established. And frankly, in the near term, that's probably what they have to do. And we as employees have to think of it as, if that's not necessarily a bad thing if I'm going to stick on the payroll and I'm going to continue to have health insurance. Our focus becomes very short term in these periods of time, which isn't necessarily a bad thing, right? We're trying to get through this very short period of time of unrest and uncertainty. So we have to look at those things on a more day-to-day basis. However, what I would say is, to the extent possible, understand that people are under a lot of financial pressure right now. Continuing the exercise of contributing to those retirement plans is incredibly important. A lot of things have been set up over recent years to help employees and nudge them towards that that good behavior of saving for retirement through automatic enrollments and automatic investments into certain mutual funds. And, none of us like uncertainty, so we tend to want to be circling the wagons and pulling everything into right now. But and that is important given the current situation we're in. But I would impress upon people to the best of your ability, keep that contribution going, even just a little bit. Undoing a routine, it's very, 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 very hard to get that routine back up and running. So if you can keep it going for a little bit, when and if things return to normal, and whatever normal means, it's certainly going to be much easier to say, okay, I can now crank that up, versus starting from zero and cranking it up, starting from maybe a little bit and cranking it up, or just leaving it where it is. So I do expect contributions to be pulled back from the employer side, but that does not mean that we as individuals should pull ours back.
Yeah. No. Great advice, Jason. We can see that more have joined the webinar, so thank you for joining us. We are utilizing the chat feature to be able to submit questions. We did collect some questions ahead of time, and Emily and I are going to read those off. If you do have questions during the discussion, please feel free to use the chat feature. Emily, do you want the next question number 5?
Sure. And maybe this would be a good point, too, to just stop real quick and invite anyone who has joined in by phone to ask any questions. If anyone has anything, I'll just wait a minute before I start with my next question. Okay. So I'll move on to the next question we have here.
Actually, Emily, we did get a question from someone. Why don't we jump in on that? The question is, are you finding that your clients are pulling out of the market entirely? Great question. I would say the answer is, in some cases, that might be the case, but it is really, really personal to their personal situation. If the assets that they are pulling from the market are needed over the next 5 years, let's say, then maybe they shouldn't have been in the market to begin with, but certainly tucking those assets away. If people still have a somewhat long-term investment horizon, we are strongly encouraging them not to pull out entirely. But if that's what they really, really want to do, I mean, our goal is to make sure people sleep at night, but provide advice and nudges in the right direction to help them out. The issue is that and there's been quantitative studies done in this area and qualitative, and the quantitative tend to match the qualitative. What we have to be careful of is pulling out at the bottom. We tend to lose out on more returns in our portfolios by getting out at the bottom and getting back in too late, versus staying in at the top and riding it all the way down. So this is, as long as you have a longer term investment horizon, doesn't mean you don't pull some back, but to pull out entirely is a very tough decision. Not something that we would totally encourage. Again, with that long investment horizon, we would encourage at least some exposure to the stock market, because no one has the crystal ball, and being in the market as it works its way through this and recovers will be important. And then as the indicators come back and tell us, hey, things are really sort of in recovery, continuing to add into the market exposure may make some sense. Again, this has to be very personal planning related. And the other thing, to enhance your question, that I'm seeing is people that are at retirement, nearing retirement. It's that question of, should I be all the way out of the market? Well, when we retire, even early in our retirement, we have 30 or 40 years of investment horizon ahead of us. It's still a very, very long time. And with that, then that you can start to see where it is. It should be something that you still participate in is the stock market. It helps combat inflation and so on. So certainly not to a great extent are we seeing clients pull out of the market.
Can either of you share what our firm has done as a practice to help mitigate that risk, because that is a real concern? And I know we've done a number of adjustments to help lessen that risk exposure. Maybe you, Bill, do you want to jump in on
Yeah, sure.
some things we've done as a practice?
Yeah, sure. So we've increased, for the most part, allocations to bonds and reduced exposure to equities, particularly in sectors such as energy and cyclical industries. We're maintaining an equity focus in infrastructure, healthcare, and technology. And for the time being, we're just watching the market closely and, kind of waiting to see how the dust settles, and we'll judiciously at some point begin to increase our equity exposure once again.
And we've done this type of practice before in other crises. Can you elaborate on some of our history and why we make these maneuvers, Bill?
Well, the last time something like this happened was about a dozen years ago, and similar to what we're experiencing right now with the bond and equity allocations that we have employed, our clients' portfolios, while obviously they've gone down, they've not gone down nearly as much as the market overall. And that's one of the attractive features about having a conservative portfolio and having a mix of bonds and stocks, where you do have some downside protection in markets like this. And again, as Jason mentioned, it helps a lot of our clients sleep better at night.
Yeah. You want to go ahead and take the next one, Emily? It's very much related to what Bill is speaking on.
Sure. So our next question here was, is this worse than 2008?
No. In some ways, yes. In some ways, no. Obviously, this is a health care crisis, a health crisis, and so from that perspective, from the perspective of humanity, it's much worse because people are dying and getting sick. From a strictly an economic perspective, this is an exogenous shock that really came out of left field. The economy was doing quite well right up until the coronavirus hit. In 2008, you had a systemic failure of the financial system, which took a long time to repair and impacted just about every industry in the economy. I think it's likely that while the current economic damage is far swifter and far more severe, with going on 20 million or over 20 million people losing their jobs in a month, I think we're also likely to get a much faster, much sharper rebound once the shelter-in-place protocols, are relieved. So I would say economically it is not as bad as it was in 2008. But right now it doesn't feel that way. But I think if you take a little bit of a longer-term outlook, I think ultimately it will not be as bad as 2008.
Do you want to read the next question, Emily? It looks like we had another one come in.
Okay, yes. So we received a question in the chat. Her question is, my portfolio is based entirely on income earning. Approximately 2/3 is bonds, some cash, but mostly 1/3 in equities. I am partially retired, but rely heavily on the income in my portfolio. Should I be worried about losing my stream of income? I know this is a broad question.
In regards to your portfolio and being income-based, the things that I would be reviewing, again, not knowing the individual makeup of the holdings, I'd be looking at, start with the equities, because those can be part of your income earners in the way of dividends. And, one of the things that we're looking at is, how are those dividends impacted by corporate earnings, over the next several months. So if you rely on dividend paying stocks as a part of that income, yes, that could potentially be at risk. The bond portion, you have probably already invested prior to this in those bonds, and depending on the duration and the maturities of those bonds, you probably see a consistent stream of income, at least for the time being, assuming they are of good quality. A lot of assumptions here, sorry. As those bonds are maturing, if any of them are maturing over the next year, 2 years, 3 years, and who knows, you are likely reinvesting at potentially lower rates, lower interest rates, and therefore the income could be impacted down the road, maybe not immediately. This would be a good time to really kind of step back. It's going to be a little hard to project, how those equities are impacted, but the bond portfolio should be pretty straightforward. Stepping back and looking at, when do these bonds mature and how much income am I receiving off of those, and understanding when those will mature and how they may be impacted going forward with the income. So it is a good point of time to kind of be reviewing that and reviewing expenses and so on to make sure cash flow is matching up. Really dependent on individual holdings.
For the person that chimed in with that question, is that information helpful, or would you like to expand? Okay, we'll go on to the next question. Something that's been happening that's been kind of neat is there are insurance companies that are providing rebate relief for customers. Jason, can you expand as to what kind of companies are? Oh, let's see. I'm having a hard time reading these questions, Emily. You may have to take them as they come in. It looks like she had another question.
Okay, the follow-up question to that one was, my advisor suggests that I stay put. What are your thoughts?
Yeah, to the extent that that's a follow-up on some of the others that you've asked, potentially that is good advice. When we're working through client portfolios, we want to be making conscious decisions in all of this. So, assuming that you have had that review with your advisor and his suggestion is to stay put, again, to the extent that you're relying on the portfolio for income and the asset allocation as it is, it seems that there's potentially some principal protection there, and likely income will be relatively stable. Again, dividends unsure of the maturities of your bonds. If you've had that conscious review with your advisor, those are the decisions that's what you want to be basing that decision on. So it can make some sense depending on the holdings.
Great. We have another question coming in through the chat, but just another reminder too that when your question is being answered, please feel free to chime in. And also, if anyone who has joined in by phone, if you have any questions, I'll just I'll just wait a second here for you if you'd like to come in with any questions. Okay, so the next question we received, hasn't the S&P 500 historically provided better returns for any 25 to 30-year period? So even in this period, if I have funds I don't need for 25 to 30 years, shouldn't I just park it there?
Well, that is true. The S&P 500 or stocks in general have provided the best returns over long periods of time. And if you have a long-term investment horizon, that is where you're likely to get the best returns going forward. There have been many, many studies bearing that out. So I would say yes.
Do you want to expand on that, Jason? Yeah, I was going to say, go ahead, Jason.
I would certainly agree with that. And I mean, just given the information in the question, sure, if I've got $10,000 and I know I don't need that $10,000 for 25 to 30 years, then leave it, absolutely. When portfolio structuring really needs to be applied to where we are in point of life and what are these funds being used for. And so there should be some mix there as well, depending on goals, objectives, and again, stage of life that you're in. If you're 10, 15, 20 years away from retirement, or maybe you're 15, 18 years away from sending a kid to college, certainly you can take a more aggressive stance. And as I mentioned before, even moving towards that retirement date, it does not mean that now I need to flip everything out of equities into cash and bonds, because you still have 25, 30 years in retirement that you are going to use this money over. But per the other questions, some of the prior questioning in terms of portfolio allocation, it does need to be matched. I mean, during this time, if you're relying on a stream of income, let's say 100% from equities, and dividends are at risk, certainly you want to have some in more principal protected, income-based, and even cash. The cash, it doesn't really earn as much right now with interest rates as low as it is, but having a portfolio made up to match the timing of when you're going to need to be spending those monies, and that needs to be constantly reviewed and conscious decisions made. You want to have that stock market exposure, even in whether it's over a long period of time, certainly, because that's going to be your best combatant against inflation. One of a couple of the most powerful forces in the universe is inflation, and what we worry about as planners is how does inflation impact our cost of living. And the S&P 500 or stock market in general has proven to be the best combatant against inflation. So certainly long time horizon, equity markets, but make sure you are matching portfolio allocation to your needs over a period of time.
I think something you can also add, Jason, a broader question to our guest there is, that's the S&P 500. That would obviously be an index fund. There's two different styles of management, and they're both useful, passive versus active investment style and approaches. Do you want to add, and explain the difference between the two and how they can be used for different goals and stages of life?
Absolutely. Big question.
Yeah, right. Sorry.
No, you're fine. This is good. Correct. If a lot of people base a lot of this, decision making off of the S&P 500, really what the reference is, the S&P 500 being a stock index, they're talking about the broader market in general. Why do we not say the Dow Jones? Because if you're having a cocktail conversation, most people will actually quote the Dow Jones, which is it's incredibly interesting from a behavioral standpoint. The Dow Jones Industrial Index is 30 stocks, but back in the day, that's been the longest standing quoted index. S&P 500 is much broader, but there are even broader indexes and even funds to invest in to capture more of the stock market. So multiple ways to invest. Yes, there is such thing as indexing, and we call that the set it and forget it style of investing. You're using passively managed funds, and about the only thing you're managing is really exposure. Could be exposure to large cap versus small cap versus mid cap versus international and bonds. It could be in the market, out of the market, it could be cash, whatever. So you're not so much picking individual positions or even necessarily sectors in a very in the true definition of passive investing. With more active investing, you are actually picking sectors and even right down to individual positions, something that Bill mentioned earlier in the conversation about moves that we made. We're active investors as an example, but one of the moves we made was exiting a lot of energy holdings and even foreign holdings at the beginning of this market sell-off. We were able to pinpoint the areas we saw as greatest risk and move those into more conservative investment. That's what active investing allows you to do, to be more pointed, more detail oriented versus the set it and forget it, quoting the infomercial.
Looks like we had another question or comment. Emily, can you read that for us?
That was just a follow-up comment there. Great
Okay.
answers. So as I get closer to the end of that 25 years, I need to mix differently. Sounds good.
Okay. Wonderful. Glad we can help. Do you want to jump down to, let's say, kind of on topic there, Emily, question number 11?
Sure. That question was, manufacturing production numbers are down over 6%. Netflix is reaching all-time highs. Should we be more willing to invest in FANG?
That gets pretty specific. The manufacturing production will probably get worse before it gets better, just because of everything that's going on. Those same trends are benefiting certain types of companies like Netflix, because people are home. What do? They watch television, they watch Netflix, they play video games, they use social media. That's what's going on right now. I think you also want to look longer term and look beyond this crisis, because it will pass sooner or later, and make sure that the sectors you're invested in are good for the long term. The FANG stocks in particular have done well in pretty much all kinds of market environments. Those particular companies are very large. They are well positioned. They have strong balance sheets. Ones like Amazon and Microsoft are big in the cloud. The cloud is getting a lot of use now with people working from home. Some even look at the FANG stocks as a proxy for the market. Others would say that these are very crowded trades, and they somehow get out of favor. There could be risks. So, our general philosophy is you want to be diversified. You want to have a longer term outlook, and the FANG stocks certainly can be part of it.
I think it's more taking time for those that are joining us via phone. We're going to leave a little bit of space here. If you want to chime in and ask any questions, feel free to do so. If we also have our contact information in the background, if you would like to request more information, or you're interested in having a little bit of a deeper dive review on your personal situation, our email address is up there. I can be reached at postw@jgua.com, and we'd be happy to help you. We're going to go ahead and leave the line open just for a little bit for those that are calling in before we jump into the next question. Okay, here's a question I'll ask. I'm going to go ahead and ask question number 8, Emily. The new bill was just passed last night. Looks like it's going to provide $100 billion to the healthcare sector, with $75 billion to local and rural hospitals, and 25 for COVID testing. Our firm is a big fan of investing in healthcare. Do we have any concerns as the sector is clearly in need of aid? What are your thoughts on that?
Why don't I start with a little bit, and Bill can chime in more on the specifics of the healthcare investing. So first of all, the bill passed the Senate yesterday, expected to pass the House today. And as we watch the CARES Act come through, it's likely to get held up by something. Let's hope not, because a lot of what the intention of this bill is putting more money into the SBA funding coffers, if you will, for small businesses, which the rollout and the lending of the first round of funding, a little chaotic, a little basically everyone headed for the door at the same time, left a lot of people out of the mix, if you will, a lot of pending applications and so on. So much needed. What we're hearing from the hospital, especially local, if you follow local news, Arnott and Guthrie laying people off, furloughing people because they know the revenue's down. With people avoiding going to get health care other than COVID type health care or emergency or something that is absolutely needed type of health care. So propping up healthcare institutions, I think, is needed to have them survive. We've watched just in our local area, we watch some consolidation and some issues with that. So certainly this type of funding is needed. Testing has been continuously pushed as something that is needed to really help us understand, is it time to open the economy up or not? And but all testing across the board, we're talking testing do people actually have the virus, and antibody testing, and that allows federal, state, local governments to decide when and how to start opening things up again. Yes, we have a major focus on healthcare in our portfolios, but it is not necessarily in the areas where this is helping, so to speak. Bill, why don't you take it from there?
Sure, Jason. So what you're seeing in the local area is being experienced throughout the country. So many hospitals have completely eliminated any so-called elective procedures that are not COVID related. And so that's forcing them for hospitals that aren't being completely inundated with COVID patients, that means they're ironically not getting enough traffic through the door, so to speak, and that's causing them to do layoffs, and so as Jason mentioned, they need kind of a life preserver, if you will, to keep them afloat until the crisis passes. I think once it does, if you need a knee replacement, excuse me, if you need a knee replacement, you're not getting it today, but sooner or later you're going to get that knee replaced because you need it. And so that business is going to come back to the hospitals. It's just a matter of when. It's not a matter of if, it's a matter of when. More broadly, the other issue is testing. There's not been adequate testing. There's a lot of questions about whether the various tests that are being put out in the market even work properly, if they're giving reliable results. So there's that's a huge issue, because until we have testing that is number one, reliable, and number two, widely available to millions of people, we don't really have a handle on on who's infected and what the real infection rates are. Whatever's being reported, the only thing we know is that they're being underreported because we don't have enough people being tested. So that, as Jason mentioned, is a huge factor in leaders making decisions to reopen the economy. You don't want to do it too quickly and then have a second wave of infections, because that would obviously be negative for both health, public health, and for the economy as well. So, we need more testing as soon as possible.
Emily, can you share what the? Okay, sorry. Go ahead, Jason.
Oh, I was just going to add to that. You had mentioned, Will, our focus on healthcare, which our focus really tends to be not in healthcare properties or healthcare services. Ours tend to be proprietary pharmaceuticals and biotechs, and these are the areas that where you're going to see testing, vaccines, treatments, things like that come through is those companies.
Good clarification. Thank you, Jason. Emily, can you share with those that are joining us, we started talking briefly about the relief package, what the chamber is doing to be able to help provide resources to business owners that are in need of some of the relief packages that are coming out?
Sure. So the chamber is going to be working on a list of local chamber member 7A lenders that can help local businesses with the Paycheck Protection Program loans. So we can provide that list to participants here and make it available on our resource page when it's ready.
So if anybody needs anything, feel free to reach out to the chamber. It's kind of continuing that conversation about debt. Obviously, we're all very worried about the amount of debt that's being accrued at the federal level. What are your guys' concerns long term? We have to pay this back somehow.
Yeah, this is it's an issue that has been continued to be kicked down the road, as we continue to basically print money, issue debt. The decision making around it to actually solve it will be painful when we're in a situation where we feel we can address this as a country. But it's not now. Now, like I said earlier, we're unfortunately in a situation where the federal government has to feel like they have a blank check. They can throw every tool they have in the toolbox at this thing to help get us through. Down the road, what are some of the decisions that have to be made? Because what wins popularity and what wins elections is usually some lower taxes. And so the question might be, do we actually have to go back the other direction and increase tax revenue, right? So when you're, we've got business owners on the call or on the webinar listening. I mean, this is about what comes in versus what goes out, and where you start generally top line and look at revenues. Can we increase them, make them more efficient, whatever, and then you start to go down to expenses and what can be cut. And that's tends to be where some of the harder decisions are made. Is as we've seen in these bills, there's a lot of things that get stuffed in there, not the stimulus bills necessarily, but bills over the last several years, funding for certain types of programs and whatever. But unfortunately, this is just money. It comes back down to the basics of money in, money out, and those decisions are not popular, and they don't win people elections. And that's where we need to be. We have to go into it with a mentality that we've got to have at least a balanced budget to start with, and budget surplus hopefully is what it allows us to down the road start paying back some of this debt. Bill, I'll turn that over to you.
Well, I don't have too much to add to that. That was well said. Like you said, we're kicking the can down the road, and raising taxes and cutting entitlement programs is never popular, and it doesn't win elections. So it's hard to envision political will, coming about to tackle these issues. I mean, it may take another crisis, a debt crisis at some point down the road. How far down the road is it? It's hard to say. Modern monetary theory holds that a country that can issue debt in their own currency can theoretically just keep on doing that indefinitely. It's never been tested in the real world. Maybe we're testing it now. I hope not. But it's really an issue, and it's really hard to get a grip on it because it's so big.
What can you add, Jason? For those that aren't familiar with our firm or our practice, obviously we have debt concerns, which means eventually likely higher taxes. Our firm doesn't just do investment research and analysis for our clients, but we also have a tax department. Can you discuss the importance on coordinating both plans, as that might be of very high importance moving forward?
Right. Yeah, absolutely. We, as a firm, we tend to look at, we're not just the investment folks. We are, and the returns on the investments aren't the end. They're sort of this means to the end. There's this, there's this a big picture in all of our lives, and the assets we accumulate are being accumulated for a purpose somewhere down the road, and planning around them in a number of different areas, not even just taxes, Will, as you mentioned, but in a number of different ways, is just as important as the management of those assets. And you can just call it all one. This is all about asset management, right? How do you invest? Buying in the stock market, selling in the stock market, bonds, cash, whatever. But there's also the protection of those assets, which can be insurance, and utilizing the right type of insurance to protect plans and your assets going forward. Taxes, as Will, as you mentioned, is really about, it should be more about, what goes on during the year and less about what we all just went through or are continuing to go through, because we now have an extended deadline of July 15th. But what is the planning to take advantage of some of the between the line areas of the tax code to benefit ourselves? Interestingly, even as individuals, when we think about that and say, well, what does tax planning really mean? In our minds, it tends to be, how do I pay the least amount of tax now? And in actuality, I prefer the term optimization, right? Because it may make more sense right now for us to be paying taxes. I mean, look at our tax rates. They are extremely low. And if we do move down this path of potentially higher taxes, then wouldn't we rather be paying more taxes now if we think tax rates are going to be higher in the future, whether by legislative action or just by what our personal situation is? So it's not just, it does have to deal with tax savings now, but it is also more tax optimization. How much tax should I be paying? What programs can I take advantage of to save taxes, but what programs should I be taking advantage of looking down the road, not just currently, but down the road, to pay taxes now in hopes that I'm saving more taxes later. And that's kind of our approach. Ours is more when we get to, February, March, April, that's just that's the check the box, right? That's just the sending in the forms and being done with it. All the work tends to get done January to December in terms of the planning.
Looks like we're about to wrap up on time. You mentioned something I want to bring up about protecting your assets. There's a number of insurance relief programs out there right now, Jason. Can you share on what areas of insurance maybe some of our viewers can be looking into to see if there are relief opportunities there that they may not be aware of?
Sure. I mean, some of the things that we've identified at the lowest level is auto insurance. There's a lot of companies coming out offering rebates for a couple of months or giving premiums back. Now is a good time in a lot of areas to review, the insurance that you do have. And I would start with the health insurance. Obviously, given the situation we're in and we're not out of it yet, what coverage do you have? If it's through an employer, we talked a little bit about before, you know, employers are really trying to keep people employed and continue to maybe cost share in that health insurance. You know, what types of programs are available to help. I have not heard substantially any, you know, reduction in premiums, because frankly, that's an area that's of great focus and need right now. Haven't heard a whole lot about homeowners programs. A lot of people are staying at home. The reason for the auto rebates is really because people are driving less right now, and it makes a lot of sense that they're not creating the risk on the roads like they are. So if you have some other supplementary programs, you know, if you have watercraft or something like that, you know, it's a good time to check in with the agent to say, hey, you know, I see some of these companies are doing things in terms of auto premiums. Are they doing the same thing in these other areas?
Looks like we've reached 11 o'clock for those that are still on the call. Do you have any last minute questions you'd like to ask? We want to value your guys' time. Any final closing remarks from you, Jason and Bill?
Well, thank you for having us, Emily, and partnering with us on this program. Good luck to the business owners out there as you know, you continue to try to work your way through this. And you know, I'll take the public platform to say thank you to the healthcare workers at all levels. Could be doctors and nurses on the front lines, could be the maintenance staff of the hospitals. Thank you very much for everything you're doing to keep us all safe, and appreciate you're risking yourselves to take care of our friends and family. So thank you.
I'd like to thank everyone for participating, and Will and Emily, thanks for moderating this and setting this up. I think this is very valuable, and just good luck to everyone, and hope everyone stays safe. Thanks.
Well, thank you, gentlemen. Anything you'd like to add, Emily?
The Chamber would like to thank you all for joining us today, and thanks to Bill and Jason and Will for presenting today. We truly appreciate you, and hope everyone has a very, very nice day today. Enjoy some sunshine.
And some snow, apparently.
Right.
Yeah.
Yeah.
What is going on? Absolutely. Well, thank you, everybody. We appreciate your time. Be well and be safe. Bye-bye.
Thank you.